$1,700,000,000 gone in a single day. That's how much the Hunt brothers lost when silver crashed on March 27, 1980. Two men who once controlled a third of the world's private silver, reduced to begging bankers. They hadn't just bet on silver, they'd bet against the entire global financial system. For a terrifying moment, it looked like they might actually win. How did a Texas oil dynasty push silver from $6 an ounce to $50, nearly blow up Wall Street, and then get wiped out when the rules changed mid-game? We'll follow the money from Texas oil fields to Swiss vaults, uncover the invisible leverage that built a time bomb, and connect this old-school corner to modern battles like GameStop and the buy button fiasco. Picture Dallas, Texas in the 1960s. Oil derricks, cowboy hats, and one man at the center of it all, H.L. Hunt. He was the classic Texas oil tycoon, rumored to have financed his first big well with poker winnings. By the time he died in 1974, he was probably the richest man in the world. But the wealth he left his sons came with something more dangerous than money: paranoia. H.L. Hunt believed Washington was sliding toward socialism. He drilled one idea into his children: never trust paper, money, stocks, or promises. Real security, he told them, lived in things you could touch: land, oil, and precious metals. His eldest son, Nelson Bunker Hunt, took that lesson as gospel. In the early 1960s, Bunker's company discovered a colossal oil field in Libya, Track 65. It made him, on paper, the richest individual alive. Then in 1973, Colonel Gaddafi nationalized it, wiping out billions and showing Bunker how fast governments could take everything. When Nixon closed the gold window in 1971 and the dollar became a pure fiat currency, Bunker saw apocalypse. He joined the John Birch Society, talked about a coming monetary collapse, and swore never to let the government do that to him again. There was a problem. Americans still weren't allowed to own serious amounts of gold bullion. Silver, though, silver was legal, and silver was special. Industrial demand, film, electronics, medical x-rays, already consumed more silver than mines produced. For years, the U.S. Treasury quietly filled the gap by dumping its strategic silver stockpile onto the market. Bunker and his brother Herbert did the math. Once that government dumping stopped, prices would have to explode. Silver became their perfect vehicle, an inflation hedge with a built-in supply squeeze. So in 1973, when silver hovered around $1.50 an ounce, the Hunts started buying. Not just futures contracts. They wanted bars, tons of them. They took delivery on contracts other traders rolled. Every time they accepted metal instead of cash, they were shrinking the pool of silver available to industry and short sellers. Slowly, quietly, they were pulling physical silver out of circulation. And they didn't trust American vaults either. To Bunker, the U.S. government was always one emergency order away from confiscation. So the brothers did something straight out of a heist movie. They hired 3 Boeing 707 cargo jets, loaded them with millions of ounces of silver, and flew the bullion to Zurich. From the runway, convoys hauled the metal into deep Swiss vaults. Texas cowboys stood in European bank basements, watching their apocalypse insurance disappear behind steel doors. On paper, they were just hedging against inflation. In Bunker's mind, he was building a parallel currency for the day the dollar died. But the Hunts had already shown regulators their appetite for domination. In 1977, they tried to corner soybeans, buying rights to roughly a third of the U.S. crop. The Commodity Futures Trading Commission slapped them down and fined them. It was a warning shot. The brothers read it as proof that regulators were just protecting weak players from smart money. So when they turned fully to silver, they came back bigger, bolder, and with friends. By 1979, they realized even a multi-billion-dollar oil inheritance might not be enough to corner an entire global metal. So they went shopping for allies with bottomless pockets. They found them in the Middle East. The 1970s oil shocks had flooded Saudi elites with petrodollars. Many of those families shared the Hunts' distrust of Western paper. Together, they set up a Bermuda company, International Metals Investment Company, IMEC. On one side, Texas oil money. On the other, Saudi oil billions. Through IMEC, the Hunts and their Saudi partners borrowed against their growing silver holdings. As prices rose, their pile looked more valuable, and those unrealized gains became collateral for more loans, which funded more silver. This was the invisible debt building in the background, leverage layered on top of rising prices. By late 1979, they weren't just players in the silver market, they were the market. Reconstruction of their books suggests they controlled somewhere between 195 and 250 million ounces in total exposure. The world mined about 380 million ounces a year. The Hunts and their allies effectively controlled more than half an annual global output and roughly a third of all silver not held by governments. Every short seller on the COMEX, every refiner hedging, every bank trading was increasingly on the other side of their trades. If those shorts needed to buy silver to close their positions, they'd be buying from the Hunts, and the Hunts weren't selling. Now mix that powder keg with geopolitics. 1979, the Shah falls in Iran. The hostage crisis explodes on TV. The Soviets invade Afghanistan. Oil prices spike. Inflation in the U.S. surges toward double digits. Investors panic. Everyone wants hard assets. And there in the middle of it sit the Hunt brothers, already massively long silver. On January 1st, 1979, silver traded at about $6 an ounce. By Christmas, it blasted through $25. On January 17th and 18th, 1980, COMEX silver futures hit an intraday high above $50. In just over a year, silver had risen more than 700%. The ancient gold to silver ratio, usually around 16:1 or higher, snapped tighter than anyone had seen in modern times. All over America, the mania spilled into daily life. People raided their dining rooms. Grandmothers' sterling flatware, family tea services, heirloom candlesticks, suddenly they were worth real money as scrap. Lines formed at pawn shops and refiners as trophies. Bowls and old coins were melted into bricks. Meanwhile, a darker wave rippled through the country. Thieves realized something simple. Silver was better loot than televisions. Burglary rings began targeting only silver, bypassing cash and electronics. In Washington, D.C., one notorious burglar built a fortune on stolen silver before finally being caught. All because a metal in the ground had turned into a speculative fever dream. By early 1980, silver had become more than a commodity. It was a moral issue. On March 26, 1980, Tiffany & Co. took out a brutal full-page ad in the New York Times. "We think it is unconscionable," it blared, "for anyone to hoard several billion, yes billion, dollars worth of silver and thus drive the price up so high that others must pay artificially high prices for articles made of silver." That ad did something powerful. It turned the Hunts from eccentric billionaires into public villains. It told America, these men are why your wedding silver is so expensive, why hospitals pay more for X-ray film, why factories are hurting. And it gave the establishment cover to do what it already wanted to do: stop them. Because behind the scenes, the real panic wasn't about tea sets. It was about the people on the other side of the trade. Many members of the COMEX board of directors worked for firms that were heavily short silver. If silver stayed at $50, those firms could be destroyed, and the exchange's clearinghouse might not survive either. In other words, the Hunts weren't just endangering rival traders. They were threatening the plumbing of the financial system, and the referees were also players who were losing. So they changed the rules. On January 7, 1980, COMEX introduced Silver Rule 7. It sounds harmless. It wasn't. Rule 7 massively hiked margin requirements on large silver positions. Before, the Hunts had been allowed to count their soaring paper profits as collateral. Now they needed real cash, fast for every ounce they controlled. Almost overnight, their pyramid of leverage flipped into a punishing liability. At the same time, Federal Reserve Chairman Paul Volcker was leading his own war against inflation. He quietly leaned on banks, warning them to stop lending for commodity speculation. No more easy credit for silver bets. The Hunts found their credit lines shrinking just as their margin calls ballooned. Still, they tried to hang on. Then came the Black Swan moment, January 21st, 1980. COMEX announced that silver trading was now liquidation only. You could sell, you could close a position, but you could not open new long positions. In plain English, no more buying pressure, only forced selling. Imagine a crowded theater where the doors are locked from one side. Everyone can only go out, no one can come in. That day marked the peak of the squeeze and the start of the collapse. From that point, silver's chart became a jagged cliff. From $50, it fell through the 30s, then the 20s. For an unleveraged investor, that would hurt. For the Hunts buried in borrowed money, it was lethal. Because here's the brutal thing about leverage. You can look like a billionaire on paper and still not have enough cash to answer your broker's phone call. By March 1980, the Hunts were paying millions every single day just to meet margin calls, interest, and storage fees. They were selling other assets, oil fields, ranches, anything liquid, to raise cash. But the math was relentless. The lower silver fell, the more cash they owed. Their primary broker, Bach Halsey Stewart Shields, had extended them hundreds of millions in credit. If the Hunts couldn't pay, Bach might go under. If Bach went under, the damage would spread to banks that financed Bach and to other brokers intertwined with the silver trade. On Thursday, March 27, 1980, the call came. The Hunts owed $135 million, due immediately. They didn't have it. Word hit the trading pits. Panic detonated. Silver opened at $15.80. By the close, it was $10.80. A one-day drop of almost a third. From the January peak, silver had now crashed nearly 80%. The Dow Jones slid as traders dumped stocks to raise cash. Rumors swirled that a major Wall Street firm was insolvent. The Hunts' net worth vaporized. They now owed roughly $1.7 billion. More than 20 banks had lent into this silver pyramid, directly or indirectly. The invisible debt behind the corner was now visible and terrifying. Paul Volcker and other regulators had a dilemma. They had squeezed credit and blessed the rule changes that crushed the Hunts. But if the Hunts actually failed, those same moves might crater the banks. So they did something that should sound very familiar today. They organized a bailout, not of the Hunts' fortune, but of the system around them. A consortium of banks, led by Morgan Guaranty and Citibank, agreed to extend the Hunts about $1.1 billion in emergency credit. The terms were brutal. The brothers pledged almost everything: Placid Oil, their prized drilling assets, ranches, art, racehorses, even personal real estate and remaining silver. They weren't rescued so much as placed in financial captivity. The priority was clear: save the brokers and banks first, keep the pipes of Wall Street from freezing. The Hunts themselves could be slowly dismantled over time. In the years after Silver Thursday, lawsuits rained down. Peru's state mining company, Minpico, sued them for manipulating the market. In 1988, a jury agreed. The Hunts were found liable and ordered to pay more than $130 million. Regulators banned them from commodities trading and levied fines. As oil prices slumped in the mid-1980s, their remaining empire buckled. In 1988, Bunker and Herbert Hunt filed for what was then the largest personal bankruptcy in U.S. history. To satisfy creditors, they sold off treasures, Kanacharium, Bunker's legendary collection of ancient Greek and Roman coins, their thoroughbred horses, art, jewelry, even Rolexes. The men who once tried to own the world's silver now stood in auction rooms, watching their past lives go to the highest bidder. Their brother Lamar managed to stay afloat and kept the Kansas City Chiefs. The wider Hunt family slowly rebuilt a new, more cautious fortune. Bunker, though, never changed his story. Until his death in 2014, he insisted he'd been the victim, crushed by a conspiracy of Wall Street and Washington. So who really had the money in this saga? At first, the Hunts did. Oil wealth converted into silver bars and vaults. Then the banks did, holding their debt, their collateral, their fate. And finally, the system itself did. Exchanges, clearinghouses, regulators, all deciding who could buy, who could sell, and when the game would stop. The invisible debt was leverage. Every ounce the Hunts controlled sat on a mountain of borrowed dollars. As long as prices rose, that leverage was invisible and harmless. The moment prices turned, it became a weapon pointed back at them and at their lenders. The Black Swan was not a war or a coup. It was a rule change, liquidation only, that turned a wild market into a one-way trap. Decades later, during the GameStop squeeze of 2021, traders watched history rhyme. Brokerages disabled the buy button on heavily shorted stocks. Prices tumbled. Older traders looked at their screens and thought, "This is Silver Thursday with memes." There's a harsh lesson buried in the Hunt brothers' story. Markets are not gladiator arenas where the strongest always win. They're casinos attached to a power grid. When a few players threaten that grid, whether they're Texas oil heirs or anonymous Redditors, someone in the back room will reach for the off switch. The Hunts thought they were buying safety from a collapsing dollar. They were right about inflation and currency debasement. They were just wrong about the timeline, and fatally wrong about leverage. They believed that if you owned enough of a thing the world needed, you could dictate terms. Instead, they discovered a truth that echoes through every squeeze and crash. You can corner a commodity, you can corner the shorts, but you can't corner the rule makers. And when your bet threatens their system, it's not the price of silver that matters anymore. It's whether you're allowed to keep playing at all.